I'm going to tell you what happens when you pay extra on your loan payment and what you need to know to make sure it gets paid the quickest. Hey there, Tom the Banker here, and I'm a financial and wealth coach. If you want to learn how to gain confidence with your money and create financial abundance in your life, then you're in the right place. Before we begin, don't forget to hit the subscribe button and the bell icon so that you're the first to know when I upload a new video. And as always, this video is provided for informational purposes only and should not be considered professional advice. So I was working with a coaching client not too long ago who mentioned that he wanted to pay off his mortgage. And he didn't want to pay anything extra early until he had the entire amount to pay because he felt there was no benefit to paying anything up front. And this is absolutely untrue. So like I did for him, I'm going to clear up any misconceptions about what happens when you pay extra on a loan. This video is for anyone who has a fixed rate, fixed term loan, like a mortgage loan, a car loan, or an unsecured loan, and who wants to pay them off quicker. But I'd like to know if you pay down your loans ahead of time and what your main concerns are about doing so. So put a comment below. To get a better understanding, let's first talk about how loan payments work in general. Loans are given to a borrower at a specific interest rate for a specific term. In turn, the borrower agrees to pay a certain amount back each month until the loan is paid off. This amount is known as your monthly payment. So for example, in our loan payment calculator, we're going to put an annual interest rate of 5%, 0 points, we'll just assume this is a regular loan, with a purchase price of $20,000 for whatever it is that you're buying, and let's just say that that's the total amount without anything down, so we'll put 0% down, and a term of 36 months. So the loan amount is going to be $20,000 because there's no money down, the purchase price is $20,000. That comes up with a monthly payment of $599.42 to be paid back each month. Your financial institution may provide you with a coupon book so you can make your payment, or you may be able to pay your monthly payment online. In addition to this, your financial institution sometimes provides you with an amortization table. An amortization table is a listing of every payment due on your loan, with a breakdown of each payment showing the calculated amount of how much will be applied to paying down the principal balance versus the amount that will be applied to paying down the interest balance. The amortization table is based on making normal payments according to the schedule that's outlined before you. But if you were to pay extra on your loan before a payment is due, wouldn't that change how much is applied to the interest for future payments? Some financial institutions will say not so fast. While the vast majority put right in their loan terms that you can prepay your loan at any time without penalty, it also generally states when you, the borrower, make a prepayment, you will tell the note holder in writing that you are doing so. So what does that really mean? Well, let's examine this further. Financial institutions are in business to create value for their shareholders, or their members in the case of credit unions. That value is directly created by the revenue the financial institution brings in from its clients. In other words, and in the case of a loan payment, they want to maximize the amount of interest they collect from you. So when you prepay extra on your loan, they may choose to apply the extra payment towards your next loan payment due, which would keep everything in line with the amortization table when it comes to determining the split between the principal and the interest being applied to your payment. In some situations, this may be okay because it reduces the amount left to pay on next month's payment if you choose. But since you didn't specifically mention that you wanted it all to be applied to principal, then it likely wasn't. So now I'm going to show you what happens when you make a payment on a loan and the bank advances your due date as opposed to paying down the principal. So I have my loan calculation spreadsheet open again using the same figures that we were showing earlier. And I'm going to pull open the amortization schedule for 3 payments. And these are the same numbers as what you saw on the amortization table as a whole. I just put them into this one spreadsheet for our purposes here. So let's say we're talking about payment number 16, 17, and 18, and you have these specific amounts going to principal, these specific amounts going to interest, which means that you have a total payment of $599.42 as noted above. So what I've done here is make an extra payment of $750 during month 16. And we see that $549.30 goes to principal, just like we mentioned. $50.12 goes to interest, just like we mentioned. But applied to the next payment is $150.58, which is the difference between the $599.42 and the $750 that we paid. So that's going to carry over into the next month, into payment 17. We're going to make another $750 payment, which is going to apply $551.59 to principal, as noted in the amortization table, $47.83, as noted in the amortization table, and applied to next month's payment $301.16. So you can see that this is just starting to snowball, and at the end of the loan term, that's when this will catch up with us and allow us to pay off the loan early. So then we go to payment 18, and we have carryover from the prior month of $301.16. We still have $298.26 due, so that's what we're going to pay. We're going to pay $298.26. We have the regular amount applied to principal, we have the $45.53 applied to interest, and we have nothing applied to the next payment. So in this specific case, if you want to continue to pay your loan payment according to the amortization schedule, you can do that just by making those extra payments. And then, you know, if this is the way that your bank applies your payments, then it'll work itself out in the end, because you may have a rough month that comes up in the future that you want to pay less. And with this particular scenario, you were able to only pay $298.26 this month, which ended up catching you up to where you were from the 2 months where you had a lot of income coming in, where you were able to make those extra payments. You know, so when the financial institution applies your extra payment to be your next payment, they're figuring it based on the outstanding principal not changing. Okay, so that's an important distinction to make between this example and the example that I'm going to go into next. So now we're back on our loan amortization table, and you see there's a new column that's been added called principal only. And we've changed our total payment column to be a variable field so we can enter in whatever payment we want. When you apply a payment to the principal of the loan, the values in the amortization table really no longer apply to your loan. This is because the interest is calculated based on the outstanding principal balance at the beginning of the payment period. It's the same reason why more of your payment amount is applied to the principal balance over the term of your loan. It's because there's simply less of a balance to charge interest against. So when you do make a principal-only payment, you need to make sure that monthly payments are still made according to the terms of your loan agreement. Since you're paying down principal, it's like you're taking payments off the back end of the loan. So your next payment is still required to be paid on time. And I'll demonstrate that here. So let's say that for the first 12 months of your loan, you make the payments as scheduled, so the $599.42 that you see here. But let's say in payment 13, you decide that you have an extra $200 that you want to be able to throw at the loan to pay it down quicker. Let me show you what that does. So $599 plus 42 cents plus $200, that's going to be $799.42. I'm going to type that in, $799.42. And you see over here in column K, we have our $200 that showed up as being a principal-only payment, with the standard amount of principal being deducted based on the principal calculation, and the interest amount based off of the starting balance of the period. Well, what happens in the subsequent periods is what you see in that other column, in column K. It shows 84 cents, 84 cents, 85 cents, 85 cents. Well, where is all this coming from? It's not just magical money that appeared. No, what it is if you make a $799.42 payment, there's $200 there. Then you start making your $599.42 payment. You still have your principal balance, which is always going to be calculated based off of the terms of the loan, but your interest calculation for a principal-only payment is going to be based off of the starting balance of the next period. So being that you accelerated the pay down of the principal by $200, this number here, that $12,920.58 on payment 14, is actually $200 lower than where it was. So that affects the amount of interest in the terms on this payment of another 84 cents. And then that just compounds over time. So let's say that you continuously make a $799 payment for a period of 6 months. That's 2, 3, 4, 5, and 6. And I'll paste that in there. You see the compounding effect still occurs. But now by the time you hit that 7th month, or month 19 in the payment process, you're now getting $5 off of each payment towards your principal. And what you want to note is that instead of having a 36-month payoff, your loan will now be paid off after payment 33 and not an entire payment of 34. See, we have a negative 104.65, so you wouldn't have had to make a full payment for payment 34 in order to pay off the loan. So just for the heck of it, let's just show you making a full year worth of extra payments. So that's 6 months, 7, 8, 9, 10, 11, 12. I'm going to paste that in there. And so if the second year of your loan, you make an extra $200 on this, loan that we're using in our example here, then you have each month with your $200 plus the subsequent savings and interest, and then the savings and interest for each month thereafter, you'll bring that loan back to be a 32 payment month. So just by paying that little extra, you're going to pay that down instead of 36 months in 32 months. So it's also noteworthy to mention that some financial institutions have adopted the practice of not allowing principal payments. Unless it's specifically prohibited by your loan documents, which I doubt, I would insist that if you want your payment to be applied to principal, you verify that it actually does get applied that way. Also, don't let anyone in your financial institution tell you that there's no difference between prepaying and paying principal only, because they haven't done the math. And we're going to right now. All right, so now let's compare the two. I've prepared this spreadsheet for this video, and I'll provide you with a link in the description where you can get this spreadsheet absolutely free so you can input your own figures and determine where you stand. But let's take the loan that we've been using through this video so far, where we had a 5% interest rate, we had 0 points, we had a purchase price of $20,000, 0% down, and a term of 36 months. So on the center section, I have the advance the due date method. And on the right-hand section, I have this apply to principal method. And you see these numbers are exactly the same all the way throughout, showing that a regular payment of $599.42 is being applied for this payment. And so what I want to show you the difference of is if you advance the due date, or whether you apply to principal, which one is going to provide you with the biggest benefit. And so over on the left-hand side, I have a payment schedule, and you see the normal regular payment of $599.42. But let's say that, let's go back to that example that I used before, where starting on payment 13 and ending on payment 24 for a whole 12 months, we're going to pay an extra $200. So let's just see what the advance the due date payment method says versus what we've already seen for applying to the principals. I think we said we're going to pay it off by payment 34, if I remember correctly. So once I input this, you'll see how many months early it'll be paid off. And in this particular example, they're both going to be paid off 4 months early. But I want you to notice that the total interest that you're going to pay back with advancing the due date only is $1,554.28. But if you apply it to principal all the way throughout and you maintain your regular payments, your total interest is only going to be a total of $1,415.44. So, you're saving, looks like what, close to $150 there. Just in interest that you wouldn't have otherwise had to pay. So that's only for a 3-year loan, though. let's do another example where we'll increase it by a little bit here. So let me try these numbers. So let's say the loan is 1.9%. It's a car loan. Okay, there's no points on a car loan generally, and we're just going to say that you're financing the entire thing. That's a $35,000 car with 0% down, and your term is 60 months. Okay, so let's say that you make double payments. So we know that this payment is $611.94, and we're going to make a double payment every single payment. So we're going to go payment 1 to payment 60, and we're going to pay an additional $611.94 each payment. And so you'll see, again, that the apply to principal method is going to significantly reduce the amount of interest that you're actually paying versus the advancing the due date method. Okay, and again, we have 30 months early, and we have 30 months early for applying to principal. So that's halfway through the loan process. But again, we see that the interest paid under advancing the due date is $1,273 versus applying to principal, and that's $845. So I'm going to dig a little bit deeper here, and I'll show you the payment schedule based off of these terms. So as you see, we have each payment listed out, how much we're paying, the additional amount that gets paid, and the total payment. So when you advance the due date, you have your payment, you have your principal, you have your interest, and then you have whatever is advancing the payment. But again, that ending balance is not going to take into the interest balance is not going to take into consideration anything that you've prepaid on the loan. So your regular interest charge is going to be applied to the starting balance. So on the other side, we show that you have your interest savings that's being built up as we did before, all the way through time. So with each payment, even though you're paying the same amount, you have an interest savings of an additional $1 here, and then it adds to $2 and $3 and $4 and $5, etc., which eventually comes up to a savings of, over $400 by the time that the loan gets paid off. So, sometimes on these shorter term loans or the lower interest loans, the results are going to be relatively close as it is in this example. But let's say that we're talking about a home loan, your mortgage, for example. So I'm going to do this last example, and then we can really see how this goes. So let's say that the interest rate on your mortgage is 4%, and you paid no points. Let's say it was a refinance, so you're not paying any additional points. Your purchase price was $255,000. You put 20% down, and your term was 360 months, so that's 30 years. So your regular payment is going to be a total of $973.93, and your total loan amount is going to be $204,000 because it's 20% down on the $255,000. So what we're going to do is we're going to do what a lot of people do, and we're going to make one additional loan payment every year for the term of the loan. And normally how this is done is when a person has a home loan, they may be paid every other week. So they would end up getting 26 paychecks over the course of a year, as opposed to 24. So some people like to take those extra paychecks and apply them to their mortgage, which let's see how that actually works out for you. So we're going to start on payment 1, and we're going to end on payment 360. So every time throughout the course of the loan, and it's going to occur every 12 months. So one payment every 12 months, which means it's going to happen 30 times within the year. 30 times within the loan, and we're going to make one extra loan payment of $973.93. And so now we see a difference. We're advancing the due date. We pay it off in 332 months, which is 28 months early, which, it's not bad. We're doing all right. But if you're applying that to principal, you get paid off 312 months, 48 months early, which is an additional savings of 20 months. And you're paying about $20,000 less in interest over the life of the loan. And you see the additional payments being made on each of them. And you see the prepayment for the applying of the principal, and then your interest savings that gets added into that over time. Bring this all the way down to where we end up having no payment left after 312 payments of the principal, apply to principal only method, versus the additional 20 more months at 332 for the advancing the due date method. So this is a graphical representation of what happens when you're advancing the due date versus the principal only. And that blue line is advancing the due dates, showing that you're still going to end up being paid off early, because you would have been paid off over here by payment 360, but you ended up paid off, in the 230s and 200 teens for the prepayment. When you go to the advanced due date method graph, what this shows is in orange, the amount of interest that's being paid on the loan versus the principal for each of the different payments. And then these slim gray lines are on top of the principal and interest payments. So that's the additional that you pay once every 12 months, if you can't really see it too well. But the orange and the blue plus the gray equals the total amount that was paid during that month. And so this is looking over the whole 360 months, and you see right at payment 300 was it 30 some, this process ends. But you can clearly see that the interest goes down over time. So let's look at the principal only graph and see how different it is. So just to switch back and forth real quick. Advance payment, you see the slope of the line for the interest versus prepaying, that slope gets even shorter and even steeper, because those gray lines are now blue lines. They're part of the principal that's being paid down. And so being that the principal is being paid down, the interest is calculating based off of that amount that's also being paid down as a part of that principal, which gives you your earlier payoff date. So that's it for this video. Thank you for watching. I hope this video provided some value to you. If so, please remember to like and subscribe, and please visit the link in the description to get your copy of the spreadsheet that we used. Remember, taking control of your finances is your first step to achieving financial abundance. Until next time, I'm Tom the Banker.